This is Scott Becker with the Becker Private Equity and Business Podcast. Thrilled today to be joined by a terrific professional who does a ton of speaking and leading and really a good person. Chad Coe. Chad, can you take a moment to introduce yourself and tell us a little bit about what your career and what you're focused on currently?
Thanks, Scott. About 27 years ago, I founded Co Financial Group, a money management and a financial planning firm that now resides in Northbrook, with 3 advisors that work with me and some staff to help make sure that my clients, my relationships can retire comfortably and stay comfortably retired. So my main focus is Co Financial Group.
And talk to us about Co Financial Group. Tell us a little bit about the trends you're watching in financial planning. Are people sort of able to manage through the recent market chaos? How much does the phone ring? How much of your time is spent almost just counseling people through the challenges? Talk a little bit about, what happens during market turmoil.
Well, if you look back the last 3 or 4 years, you could see a trend line of everybody wanting to be able to manage the money themselves. They can't get out of their own way, and the markets were going straight up. And there was conversation out there that the market can't go straight up. There has to be some pullback, some modification, or some changes in the markets. And as we now started to see that with tariffs and talk about other economic influences, it looks like people are now getting more engaged. People want to take more control. And I'm hearing from a lot of people that they want to become more defensive. So I think in summary, people are taking the time to get more involved in their portfolio. They're deciding what their risk factor or risk tolerance really is. And then they're reaching out to, as an example of me as a financial advisor, or they're reaching out to the 800 numbers that are out there, asking them for help or guidance as to what to do. As far as the phone ringing off the hook, believe it or not, when you work with a financial advisor, I think those kind of clients seem to be a little bit more relaxed about their life and portfolio, different than do-it-yourselfers that are looking at the market, 24 hours a day or looking at the news.
Right. People that have been through this for several years or that are older, have seen the ups and downs and probably breathe a little bit better. How important is that somebody has their allocation right, has an emergency fund so that they can manage through this type of turmoil without panicking too much? And how often do you get people that have not really worked on their allocation and maybe just highly weighted towards equities, but then have a hard time managing through a market turmoil? Talk
I
about
think a
that.
lot of I think a lot of people, as an example, that are do-it-yourselfers, have a tendency not to be diversified. They have a tendency to pick 5 or 10 technology stocks and throw their money at that, is what I hear. Now, when you work with a professional or you take the time to educate yourself about, growth over time in the marketplace, there's all the professionals out there that talk about diversified portfolios are the way to go. So in my world, right, my clients have diversified portfolios. In other worlds, or technology-based worlds like the robo-advisors, many times it's just dedicated to large caps or technology stocks.
And how often do you hear people, because I hear this so much, and it must be hard to listen to somebody that when the market is going up talks about how they invested in Nvidia, SoundHound, Apple, and they're a genius. How often do you hear that when the market's going up, everybody bragging about their stock picks and the picks they picked individually? And how
Yeah.
do you deal with that when the market goes up and goes down?
If they're my client, it's usually not a conversation we have because they're diversified and it might be just a few dollars that they invest that way. Number two, if you're sitting around a dinner table and they're all talking about how great they've done in the markets, one of the things we need to realize is very few people, as an example, bought Bitcoin at $10,000 and held it to $85,000. Most people buy it at 10, sell it at 20, buy it again at 30, sell it at 40 or 50. So when it comes to Nvidia or Palantir or some of the other stocks you shared with us, most people didn't necessarily buy it at a price, call it of 5, 10, 20, and $30 and hold on to it to the place where it's at now. A majority of people will just buy and trade and sell and buy again. And most people, believe it or not, there's a lot of research out there. Most people don't over time make money by trading the technology stocks or holding on to them indefinitely.
Thank you. And you mentioned something that I thought was just brilliant, that there's this concept that when you look at the long-term averages of the S&P or the Dow or something like that, it might be 8 to 10% a year over 50 to 100 years. But most people don't enjoy that for exactly the reason that you said, is they get nervous, they sell it, they buy back in when it's gone back down or back up. And so they don't really enjoy those returns. And so I'm going to ask you two questions. How much of that do you see out there, people that, you hear about these returns in the S&P and the Dow, but most people don't enjoy those because they don't just keep their money in all the way through because they do get a little nervous, which I don't blame them. And then second, do you err towards index funds, individual stocks? How do you think about those issues? And then we'll ask the same question on the bond side, treasury bonds versus munis, and how do you think about that?
So
That's a
on the
lot there, sorry.
so on the first side, people, you know, what I find right is the married couple, the older cars, the simple house. Those people retire comfortably and stay comfortably retired. There's a lot of new generation where it's the flashy watches, buying stuff, the 3 or 4 trips a year. They're spending money they don't necessarily have, and therefore they're not able to enjoy the growth of the markets because they're not really putting money away into the markets. And possibly they're putting money in their 401ks, but more often than not, believe it, there's a small percentage of people that maximize their 401ks as an example. So listen, if you want to retire comfortably, you could do it on an 8% return, compounded every 10 years, your money doubles. You could have a really great life. The key is to put away money, keep it diversified, let it grow, look at compounding, just like Albert Einstein said, it's the single greatest tool or that they've ever created or figured out. And that time is on your side. When your other question was, as an example, bonds. Oh, by the way, what I invest in. So number one, bonds. I like individual bonds that have a duration. You buy it, you hold it. Whether the bond goes up or down, you're going to get your principal out of it at duration, right? Plus the yield that you buy, call it short-term intermediate bonds. What I prefer today, new world versus old world, I like a diversified ETF portfolio. And if you have enough assets, I like to sprinkle in there individual stocks like dividend growth, mid and small. But it depends on the size of the portfolio. Mutual funds have their place, but more often than not, you could find a really great portfolio that's riddled with ETFs, exchange traded funds, and individual stocks.
100%. So ETFs, index funds, a little bit of individual stocks, but that's really a gamble on the individual stocks unless you're highly diversified and own so many of them. On the bond side, individual bonds versus bond funds, so you don't have to deal as much with interest rate risk. You still deal with some credit risk. And then what's the balance between treasury bonds, corporate bonds, municipal bonds? How do you think about those things?
I think about those as individuals come to me and have their individual tax needs and their individual growth needs. I'll apply the different bonds based upon their personal needs and wants. And as you know, when you're in a room with 10 people, every single one of them has different financial goals, different outcomes, different risk tolerance. So those are questions that we have to ask for each person that we talk to as we evolve relationships and look at their risk tolerances. They all have a place. It's just a matter of who's the right person for those.
Let me ask you another question. There are some heralded investors, the Warren Buffetts of the world. There's so many others. Are there particular investors that you think of, not so much to model yourself after, but that you particularly have admired over the long term? Are there anybody that you think of like, yes, that's someone we're really a fan of?
So believe it or not, Scott, as we went to college together and you were friends with my brother Mark, my brother Mark is the one that shared with me and taught me the business of professional money management, analyzing companies, not stocks, and finding where the value add is and doing the research on it. The other thing is when you deal with professional money managers and you ask them where the markets are going, they'll never give you that answer because what I'm told is, and you know this, nobody knows. So I would just share with you that it started with my brother Mark, learning from him professional money management from the side of the analysts. And now, 25 years later, being in the business, I use a few different money managers that have a team of analysts that diversify portfolios and keep a close eye on them. So based upon the economy, the world, or the markets, we'll always have an eye on what's going on so that we could help ensure that our clients can grow and retire comfortably if they listen to our advice.
Thank you. No, I absolutely love this. Your brother's a brilliant person, a great investor, learned a lot there. Fantastic. What are you most focused on? Chad, you also do some public speaking. You've ran some mastermind groups. Talk a little bit about some of that you do, if you don't mind.
So 20 years ago, I was helping unemployed executives get jobs, and I was able to build a nice base to my company by working with them, helping them, and then managing their 401k rollovers. As we move forward in my life and generate, in 2008 and 9, I created mastermind groups, which help people remove roadblocks from their life. And with that, I learned how to coach, mentor, and guide people to kind of have the abundant mentality. And one of the things that I'm most proud of and excited about is I just finished my 4th book, which is Your Financial Dream House. So through planning and investments and a guide, you could have the financial dream house that you dream of, where you could live comfortably, travel, enjoy your life, enjoy your family, and just basically dream abundance. What is abundance? Personal, professional, and financial. Being able to just be able to be comfortable in your own skin without stress. So I'm out there speaking. I run mastermind groups. I help people achieve their dreams and goals, one person at a time, because the world today is hard. People are nervous, and I want to help them overcome.
No, I think just absolutely fantastic. And any sort of overall advice for emerging business people, emerging leaders, any thoughts you would give to an emerging leader, emerging business person?
So I put a lot of thought into that because I used to be an emerging person who was coach, mentored, and guided. But one of the things that I would share today is I think everyone knows John Wooden. He was one of the most winningest coaches in college history, and he created the pyramid of success. And at the top of the pyramid, it talks about having patience, faith, focus, and clarity. And I think that the young ones don't have the, call it the patience and the faith that if they work every single day and do it repetitively and stay focused on what they want, they could have anything they want. So I'm a big fan of taking your time, being focused, having goals, and having clear goals, and then watch the magic, kind of unfold. The other thing I would say to young emerging leaders is read books, listen to podcasts, and know that life is a journey and it takes a lot of twists and turns. And be open-minded to the twists and turns as they show up, because that's the lane that you're going to end up in one day that's going to give you your future.
No, Chad, I want to thank you. It's amazingly impressive what you've built over the years, the intellect, the energy, the common sense, the thoughtfulness. I just love getting a chance to visit with you. Again, Chad Coe is joining us today. Chad, the name of the company where people could find out more about Chad Coe.
Coe Financial Group, coefinancialgroup.com. I'd be remiss if I didn't say happy birthday. Happy birthday, Scott. It's I think it was yesterday. We want to wish you happiness and longevity. And really, thank you very much for taking the time to share and talk with me today. It's been just fantastic.
It's a little bit like old home week, and a total pleasure, Chad. Thank you so much for joining us, and thank you very, very much. You're going to make me blush on the happy birthday stuff, but thank you.
Take care, everyone. Take care.